G'day everyone, welcome to the weekend general update for the Easter weekend. And the US market finished very strongly on Thursday night, and almost certainly there was a little bit of fund manager activity in terms of pumping the market up, making the end of quarter look a bit better, and hence getting better bonuses. So to me, the real test will be what the US market does next week. So let's get straight into it and have a look at the action of what happened last week. The S&P rose 12 points on the week and is now right to the top of the resistance zone. So we're at a key level, and if markets do what they've been doing over the last few years, I would expect that we're going to see at least a minor breakout prior to a bigger retracement back into the range. We've seen lots of false breaks. The other possibility, of course, is that the market just breaks out and keeps going. So we really need a few more weeks of action to tell us which one of those is going to be the case. Now, as I said, we are moving into the traditionally weaker time of the year, generally sometime in April. Certainly over the last 3 years that has been the case. The market has peaked in April and has gone down considerably. That was the case in 2010, 11 and 12. This year, I think that there are circumstances that are far different from what we saw in those 3 years. Those 3 years were dominated by fears of a financial collapse in Europe, and I think that's largely gone away now, although what the European bureaucrats have done with Cyprus now is not too clever, and is causing some anxiety in Europe. But putting that aside, if there isn't any sentiment shift because of what's happening in Cyprus, then I think we're going to see a reasonably benign year this year. Certainly the overall circumstances for stocks globally are as good as you could possibly get. Low interest rates, low inflation, and extreme levels of credit availability and financial stimulus. So it doesn't get any better than that for stocks. We've certainly got an improving situation in America in terms of the corporate market, the housing market, so many areas of the US economy, jobs, manufacturing are really improving. So it'll be a pretty interesting year. The ASX 200 finished flat on the week. There was no change at all, and the main losers last week were energy and material stocks that took a severe beating last week. Banks are really all that's holding the index together, but there certainly are some other really good performers in the small and mid-cap area, and that's where the money is, in those high quality companies in that space. So let's have a quick look at that action. This is the S&P. Just ignore this last little candle here. That's just a duplicate candle that's come up for Friday for some reason, bit of a glitch in the software. So if we pan back and have a look at where we are, you can see we're basically knocking on the door of the all-time highs, and we're right at the top of that trading range now. Wouldn't be surprised, as I said, to see one of two things: either a short-term break above that 1575 high, perhaps getting up into the low 1600s, and then a failure of the trend at that point. If that occurs and we pull back into the range, then I believe we'll see a correction of probably more the dimension of this whole run that started in the middle of November. And that would probably bring us back. Let's just put a bit of a framework on that. If we extended that up to about 1620, then we're probably looking at a pullback to at least below 1500. So I would expect that we could see a retracement of at least 100 points, possibly 150 points in the S&P if that were to occur. Now the other alternative, of course, is that it breaks above this 1575 resistance level into new all-time highs, as the Dow Jones has already done, and basically just keeps going, or starts to form a broad sideways range up above that 1575 level. I think they're the two most likely scenarios. But given that this is a weaker time of the year, I think there's a very real chance that we're going to see a sideways move for a while. I just can't see the circumstances where we're going to get a repeat of 2011 and 12, where we had enormous volatility and sharp downside in May, June, July and August. I just can't see the environment where that's going to happen this year. But the market can't just keep running up and up. So I think the likely alternative is we'll see some sideways movement for a period of time. Now, just turning to the Australian market, this is the relative sector index that we've been looking at now for some time. We've got healthcare in the green at the top, just clearly the outperformer by, so far it's not even funny. The next two down, huge gap down to the next two, that's telecoms and the banking index, the finance index. Then we fall down to the next red line, which is the energy index, and then at the bottom we've got the small caps, and lastly we've got basically BHP and Rio pulling up the rear, and you can see it's been quite a sharp fall in the last couple of weeks for BHP and Rio. Turning to our market, the individual indices, this is the ASX 200, so it looks quite a bit different to the S&P, which is basically at all-time highs. We are a long way below our all-time highs, and you can see back here, in fact that's not even the highs, I don't have enough data downloaded here, but you can see we're well behind where the US market is in terms of relativity to the peak. Now that's largely occurring because this is the materials index, and this is the one that's been doing the damage. BHP and Rio been sold down very heavily since the middle of February, so the last 6 weeks it's been all to the downside, and you can see another very negative day on Thursday. If we look at finance has gone the other way, and it's really the only thing that's held our index together. So there's been a massive divergence there on the Australian market, and it really is those two major stocks that are dragging things down. This is energy. Energy's done okay, certainly far better than the materials index has done. So it'd be interesting to see how our market responds over the next couple of weeks. Now, gold lost $7 on the week, still fairly quiet on the gold front. I'm looking for a close above 1625 to indicate that we're a chance of moving higher on gold. Until we get over that level, then we're stuck in that range between 1550 and 1625, and that means that 1550 support level is still one that we've got to watch very closely. Gold stock indices, they're showing some signs of further improvement, particularly the junior index in the States, which is encouraging, the fact that the junior stocks are doing a little bit better now. But we still don't really have built the momentum that I would have expected to have come through. Copper was down to $3.40, and as I've mentioned over the last couple of weeks, that really is a sign that is bothering me a fair bit, because whilst it's still a reasonably good level, the fact that it's slipped back over the last couple of months is not what I expected to see. Oil, on the other hand, has been rising. It was only a few weeks ago, it was about $91 a barrel. Now we're up to 97, so oil looking much better. This is the copper chart. You can see it's really fallen off a cliff since the end of January. It was up at $3.75. We're now down at $3.40. That's still profitable, mind you, but the trend doesn't look particularly attractive at the moment. So let's have a look at the gold charts and the gold indices. This is gold on a weekly basis, so you can see the importance of this 1550 level. It's been support for just such a long period of time now. You really got to go back to about May of 2012, so almost 12 months ago, when it really started hugging this level. We had a bit of a blip up for about 5 or 6 weeks, but then it sagged back down again. If we look at the actual individual movements last week, you can see on Thursday we did get a sharp dip, but equally it recovered again. So there are plenty of signs. You can see all through here. If we go back to the 1st of March, there's just so many long tails on these candles, which is indicating that we're seeing some downside during the trading session, but the buyers are stepping in. And that's something that we haven't seen that much of for quite some time. So there are some reasonable signs there at the moment. Now let's have a look at the GDX index. It's really at historical low valuations relative to gold. There is some important support, or it's in really a support zone at the moment. So really looking for it to turn higher from here. To indicate that it's back into uptrend, we really need to see higher highs and higher lows, which really means we need to see a close above this level here on the GDX. Now let's look at the juniors. So they're the major stocks. Let's look at the juniors. You can see I drew this similar level here, looking for higher highs and higher lows a few weeks ago, and we've certainly formed a higher high and probably formed a higher low now. This was quite a sharp dip on the 25th of March last Monday, but equally it recovered very, very quickly. So the sign's certainly looking much better for the junior index. So that's it for this week. As I said, the way that the S&P finished on Thursday night was not surprising. The funds, making things look as rosy as they could for the end of quarter. The true test of the US market will be what it does over the next week or perhaps 2 weeks. We need to see a sustained move above 1575 to indicate that this market is still buoyant and continuing to the upside. So that's it for this week. Cheers.